In this video, we will be talking about investing in bonds, where we will be catering to government bonds and corporate bonds. Bond is a debt instrument, which means that it is a fixed income instrument. It gives you fixed returns in the form of interests. Like stocks, bonds are also traded on the secondary market, but they are comparatively a lot less volatile than stocks. Now, before moving on to talking about government bonds and corporate bonds, we will be discussing a few important terminologies related to bonds. Firstly, we will be talking about face value. Face value of a bond is the price of the bond when it was first issued. So, the face value of the bond and the price of the bond at which you can buy it in the secondary market can be different. Next, we will be talking about the coupon rate. Coupon rate is basically the rate of simple interest that would be paid on the face value of the bond. So the rate of return that you get while buying a bond from the secondary market can differ from the coupon rate, because the coupon rate is the interest paid on the face value and not the current price of the bond in the secondary market. Lastly, we will be talking about the tenure of a bond. Tenure is the time after which the bond matures. As the name suggests, government bonds are the bonds issued by the state government or the central government. Governments can issue bonds for various purposes, for example, building roads. The coupon rate might be around 6 to 8% annually till the maturity of the bond. Government bonds can have different maturity periods, which could range from 91 days to even many years. Government bonds are considered to be extremely safe as they are issued by the state government or central government, so they can only be defaulted when the government which has issued the bond goes bankrupt. In any big country like India, it is highly unlikely for that to happen. Hence, you can consider these government bonds as extremely safe. Corporate bonds are the bonds issued by private companies in order to raise capital. Private companies take debt from the people in the form of corporate bonds. There are numerous ways through which a corporation can raise capital. However, many companies choose to raise corporate bonds because banks might be laying a lot of terms and conditions for giving a loan to the company, or there might be lower interest rates that they would have to pay than taking a loan from the banks, and they would not have to sell their equity in the company as well. Corporate bonds have ratings. The corporate bonds that are issued by the credit-worthy companies are rated as AAA bonds. So we should only invest in those bonds that have a AAA rating. Otherwise, there would be a high risk of getting defaulted. Corporate bonds are riskier than government bonds because there are slightly more chances that a company might not be able to repay the money than the government being unable to repay the money, as it depends on their company's future cash flows. As there are more risks involved, corporate bonds have a higher rate of interest than government bonds. Overall, investing in bonds is a great way of diversifying our investment portfolio, as it gives exposure to debt instruments. It has lower returns, but it even has lower risks involved. People with a lower risk profile, the majority of their investment portfolio should consist of bonds, as it gives regular income with less risks. Thank you for watching this video. I hope that you were able to understand about investing in bonds.